stop looking at the spot price of $91. That number is a lie. Right now, as you watch this video, the price of silver in Shanghai, China has already exploded past $114. $114 an ounce. That is an $11 to $12 premium over the COMEX price in the United States. In percentage terms, that is a massive arbitrage gap. But if you think that spread is shocking, what is happening inside the United States is even worse. The system has effectively seized up. We have received official confirmation that the United States Mint, the sovereign producer of the American Silver Eagle, has ceased operations on silver sales. They have shut the doors. Their official statement claims they need to evaluate pricing adjustments. Let me translate that from bureaucratic speak into plain English. It means the price of silver is rising so rapidly, so violently, that the US government cannot update their website fast enough to stay profitable. They are literally terrified of selling dollars for dimes. They realized that their fixed pricing models were being arbitraged by the market, and rather than losing money on every ounce sold, they simply pulled the plug, and they aren't the only ones. Costco, the retail giant, is now rationing bars like we are in a wartime economy. They have instituted a hard limit, 1 transaction per membership with a maximum of 10 units per 24 hours. And even with those limits, the inventory is flashing sold out almost immediately. We are watching a commercial signal failure. The West is trying to suppress the price to keep the illusion of currency stability, while the East is draining the vaults at any price necessary. Even $114. And in the middle of this chaos, the CME Group has dropped a nuclear option on margin requirements that changes the rules of the game forever. If you thought $91 was the story, you are missing the forest for the trees. The real story is that the physical market has decoupled from the digital price feed. This is not just a bull run. This is a paradigm shift. While the physical metal is disappearing from the US Mint and Costco, the paper markets are launching a desperate counterattack. Faced with this runaway train, the exchange authorities have made a historic, unprecedented change to the rules of engagement. We are calling it the eternal margin nuke. Traditionally, when you trade a futures contract for gold, silver, platinum, or palladium, the exchange sets a margin requirement, a fixed dollar amount. For example, to hold 5,000 ounces of silver, you might need to put up $32,000. It was a manual, deliberate process. That system is gone. Earlier this week, the CME Group announced they are switching from a fixed dollar margin to a percentage of notional value. They are effectively pegging the margin requirement to roughly 9% of the total contract value. Why is this huge? Because it automates the pain for the bulls. Let's break down the math. A standard silver contract is 5,000 ounces at $91 an ounce. That contract is worth $455,000. $455,000. Under the new rule, you need 9% of that in cash. Roughly $41,000. But here is the trap. As the price of silver goes up, the value of the contract goes up. Therefore, the 9% margin requirement goes up automatically if silver hits $100. The contract is worth $500,000, and your margin requirement jumps instantly. If it hits 150, it jumps again. This acts as an automatic braking system on the price. Every time silver rallies, it becomes more expensive to hold the position. It forces leverage out of the system. It creates a scenario where traders are constantly hit with margin calls simply because their asset is performing well. Some might argue this is just to streamline operations. But if you look at the timing, right as silver goes parabolic, right as the physical shortage hits, it looks like a desperate suppression tactic. It looks like the COMEX saying, we cannot afford to let this market run, so we are going to make it prohibitively expensive to participate. It is a Hail Mary attempt to save the short sellers. But here's the flaw in their logic. This only affects the paper speculators. It does not stop China from buying physical bars. It does not stop the US Mint from running out of coins. All this does is widen the disconnect between the fake paper price and the real physical price. Let's circle back to the implication of the US Mint shutting down, because it is critical to understand the economic gravity of this. This is exactly what happens during a hyperinflationary event or a currency collapse. You walk into a store and there are no goods on the shelves, not because the goods don't exist, but because the store owner doesn't know what to charge you. If he sells you a loaf of bread for $5 today, but it costs him $10 to replace it tomorrow, he goes out of business. The U.S. Mint is currently facing that exact dilemma. They are paralyzed by the velocity of the currency debasement relative to silver. This is not a private dealer. This is the sovereign mint. When the government stops selling its own money, silver eagles, and when the biggest retailer in America, Costco, has to ration a commodity, price discovery on the screen becomes irrelevant. The price of silver isn't $91 if you can't buy it for $91. The real price is unobtainium. We are seeing the physical market decouple from the digital price feed. The dealers are backed up, shipping times are delayed, and the banners on every bullion website are asking for patience. This is what a supply squeeze looks like in real time. While the West struggles to price silver and manage margin calls, the East has already moved on. This East-West divide is a geopolitical economic war. In a functioning, efficient global market, an arbitrage gap of this size, $91 vs $114, shouldn't happen. Traders would buy every ounce in New York, fly it to Shanghai, sell it, and pocket the risk-free profit. That process should bring the prices back together, but the spread remains. Why? Because the metal isn't moving fast enough. Or, more frighteningly, because the metal available in the West is paper silver derivative contracts that cannot be easily converted into the physical bars needed to satisfy the Chinese appetite. China is bidding for physical delivery. They are draining the global supply. They don't care about the COMEX closing price, they care about possession. We are seeing a massive flow of physical wealth from west to east. The West, specifically the US and London, has suppressed the paper price of metals for years to make the dollar and the pound look stronger than they are. But China, knowing the geopolitical landscape is fracturing, is calling the bluff. They are saying, we will pay the real market price, and that price is over $100. This puts the COMEX in a death spiral. If they don't let the price rise to match Shanghai, their vaults will be emptied. If they do let the price rise, it exposes the inflation and currency weakness they have been trying to hide. We are watching the end of Western price dominance in precious metals. Markets do not move in a vacuum. This silver explosion is being fueled by a backdrop of extreme political instability in the United States and abroad. According to analysis from Bloomberg, this rally is being driven by a combination of the Trump trade and uncertainty surrounding the Federal Reserve. There is a growing narrative in the market regarding the independence of the Federal Reserve. We are hearing reports and rumors about potential criminal indictments against Fed Chair Jerome Powell, or at the very least, a significant push to remove him from power. The market hates uncertainty, but the precious metals market loves it. If the independence of the central bank is compromised, or if the market believes the next Fed chair will be a political appointee instructed to slash rates to zero, the dollar is effectively dead in the water. Lower rates and a politicized central bank are the ultimate rocket fuel for gold and silver. Investors are front-running this possibility. They are buying insurance against a regime change in monetary policy. Add to this the aggressive foreign policy moves we are seeing. The transcript highlights tensions involving the Trump administration's actions in Venezuela, capture of leadership, and renewed rhetoric regarding the acquisition of Greenland. These are not normal geopolitical maneuvers. They signal a return to a more aggressive, imperial style of resource acquisition, when the world sees the U.S. becoming unpredictable on the global stage. And when they see internal strife in Iran with violent protests threatening the regime, capital seeks safety. Safe haven assets are not just about inflation, they are about political risk. Right now, the political risk meter is in the red. Investors are looking at the U.S. debt, the political infighting, the geopolitical aggression, and they are saying, I don't want dollars. I want something with no counterparty risk. That something is gold and silver. Despite all of this, the $91 price, the shortages, the margin hikes, the $114 China price, the most incredible thing is that we haven't even seen the mania yet. If you look back at 1980, when the Hunt brothers cornered the market, or 2011, when silver nearly hit $50, those were periods of public hysteria. People were lining up around the block to sell their grandmother's silverware, or to buy coins. We aren't there yet. The retail public is just waking up. The buying we are seeing right now is institutional. It is sovereign. It is the smart money moving first. The average person on the street has no idea that silver is at $91. They have no idea the mint has shut down. This suggests that we are still in the early to middle innings of this move. When the mainstream media starts covering this 24/7, when your taxi driver gives you stock tips on silver miners, that is the top. We are far from that sentiment. Citigroup has upgraded their forecast to $100 silver and $5,000 gold in the next 3 months, but honestly, that feels conservative. If China is already paying 114, why would the price stop at 100 in the US? The ceiling has been blown off. The inflation-adjusted high from 1,980 is the only record left to beat, and given the rate of currency creation since then, silver could theoretically go much, much higher before it reaches true equilibrium. To wrap up this analysis, we have to look at the consequences. What happens next? We are likely going to see a period of extreme volatility. The COMEX margin changes will force some paper hands to fold, creating temporary dips. But those dips will likely be bought aggressively by the physical market. The floor has moved up. The US Mint will eventually reopen sales, but you can guarantee the prices will be significantly higher. They aren't going to sell silver at a loss. The premiums on physical metal will likely stay elevated or expand further. We are moving into a two-tier market. The paper price shown on CNBC, which might be managed and suppressed, and the street price, or Shanghai price, which is the actual cost to acquire metal. For the investor, the lesson is clear. Do not rely on the spot price to tell you the value of your asset. The spot price is becoming a fiction. The true value is determined by availability. If you cannot get it, the price is infinite. We are witnessing the slow-motion death of the fractional reserve bullion banking system. They sold more paper silver than exists in reality, and now the holders of those contracts, led by China, are standing at the cold delivery window asking for their bars. The window is closing, the mint is closed, Costco is limited. The question you need to ask yourself is not will silver go to $100? It is already there in the places that matter. The question is, what will you hold when the paper market finally admits it has nothing left to deliver? Gandalf the Grey, or rather, the meme version of him mentioned in the news, said it best. Hold on tight to your physical gold and silver, you fools. It's satire, but it's also the best financial advice of the decade. The ratio is dropping, the price is climbing, and the exits are being blocked by margin hikes and sales suspensions. We will continue to monitor this historic squeeze. As the East continues to bid up the price and the West struggles to maintain the illusion of control, one thing is certain. The silver market you knew yesterday is gone. Welcome to the era of true price discovery. Thank you for listening. This has been a special report on the silver crisis. Keep your eyes on the Shanghai spread and prepare for volatility. Forget the aircraft carriers in the Taiwan Strait. Forget the fighter jets and the grand military parades. If you want to understand the true timeline of the coming global conflict, you must stop looking at what governments show you and start looking at what they hide in the ledgers of sovereign debt. Right now, a financial burn notice has been issued, and the mainstream media is too busy chasing headlines to read the footnotes. The U.S. Treasury Department has just released data that confirms a terrifying trend. China is dumping U.S. debt at a speed that defies standard economic logic. This isn't a simple portfolio rebalancing. This is the second largest economy in the world, clearing the decks for an irreversible divorce from the American financial system. When a superpower sells its rivals' debt at a record loss while simultaneously filling its bunkers with gold, oil, and grain, they aren't looking for a return on investment. They are looking for survival. Today, we dissect the $688 billion exit, the moment the smart money decided that the US dollar is no longer an asset, but a hostage. The latest Treasury International Capital (TIC) report is typically the most boring document in Washington, but the latest figures are nothing short of a catastrophe for the dollar's hegemony. As of late 2025, China's official holdings of U.S. Treasury bonds have plummeted to $688 billion. To the uninitiated, that sounds like a massive number. In reality, it represents the lowest level of Chinese ownership since May 2009. We have effectively erased 16 years of financial integration in a heartbeat. To understand the gravity of this, look back at 2013. At the peak of the symbiotic relationship often called Chimerica, Beijing held over $1.3 trillion in U.S. debt. They were the primary financiers of the American deficit, buying the bonds that allowed the U.S. to keep interest rates low while Americans bought cheap Chinese goods. That closed loop is now shattered. China has liquidated nearly 48% of its position from its peak. but the how and when are more important than the how much. Throughout 2024 and 2025, the U.S. bond market suffered a historic drawdown. Bond prices were depressed and yields were volatile. Anyone selling during this window was realizing a massive financial loss. In asset management, you don't sell a losing asset unless you are desperate for cash or you believe the asset is about to become toxic. China isn't desperate for cash. They have a massive trade surplus. They are selling because they believe the U.S. Treasury bond is no longer a store of value, it is a strategic liability. The lessons of February 2022. The catalyst for this mass exodus isn't hard to find. It started in February 2022 when the U.S. and its allies froze $300 billion of the Russian central bank's foreign exchange reserves. It was a financial nuclear strike that shocked Beijing to its core. They realized that their $1 trillion plus in U.S. assets wasn't wealth. It was a kill switch that Washington could flip at any moment. If China moves on Taiwan, or if the South China Sea heats up, their treasury holdings instantly turn into a donation to the U.S. Department of Justice. By selling now, even at a 20% loss, Beijing is saving 80% of its capital from a 100% total loss tomorrow. This is sanction evasion on a grand, strategic scale. The Bagholder Alliance. If China is dumping hundreds of billions in debt, why hasn't the market collapsed? Because as China steps out, the U.S. is forcing its allies to step in. Look at the TIC data for the United Kingdom and Belgium. The UK's holdings have surged to record highs of $750 billion, despite the UK economy being a fraction of China's size and running a trade deficit. This is not a free market decision. This is financial conscription. Washington is essentially telling its G7 partners that they must absorb the Chinese sell-off to prevent the U.S. bond market from breaking. The West is cannibalizing its own balance sheets to keep the system afloat, but this strategy has a fatal flaw: capacity. Unlike China, the UK and Europe do not have an infinite surplus of real dollars earned from manufacturing. They are buying on borrowed time, and when their currencies or voters revolt, the bid of last resort will disappear, materializing wealth from paper to physical. The most telling part of this investigation is what China is doing with the cash. They aren't buying euros or yen. They are engaging in the most aggressive commodity hoarding campaign in modern history, the golden pivot. The PBOC has been a relentless buyer of gold for nearly 2 years straight. Gold cannot be frozen by the SWIFT system. It has no counterparty risk, energy security. They are filling their strategic petroleum reserve to its 1.5 billion barrel capacity. They are building a buffer that allows them to survive a naval blockade for months, if not years. The metal mountain. China is hoarding copper, cobalt, and lithium at record levels despite a domestic housing slump. Why? Because you need these for a war economy. For munitions, drones, and grid resilience, calorie sovereignty, China now holds 60% to 70% of the world's global grain reserves. They are trading paper yields for survival. The conclusion for any rational investor is simple, yet terrifying. For 40 years, the 60-40th portfolio, 60% stocks and 40% bonds, was the gold Harak 8 active investa. Bonds were the safe haven. That era is officially over. The U.S. Treasury bond has been weaponized, and the world's largest manufacturer is walking away from the table. China is methodically, deliberately removing itself from the U.S. financial jurisdiction. They are willing to take a massive loss today to ensure they cannot be strangled tomorrow. The stability you see in the market right now is artificial. It is a house of cards propped up by political pressure on the G7 allies. So we have to ask, if the ultimate insider of the global manufacturing world is selling everything to buy gold, oil, and grain, why are you still holding the paper? Are you waiting for the pivot, or are you waiting for the collapse? The divorce is finalized. The assets are being moved. We are just waiting for the first shot to be fired. The $688 billion exit isn't just a number, it's a warning. Are you listening? In the desolate, gray shipyards of South Korea's Jeoji Island and Japan's technical hubs, a silent tragedy of capital is unfolding. 6 Arc 7 class ice-breaking LNG tankers, miracles of maritime engineering, each costing nearly $500 million, sit idle. They are the most expensive commercial vessels ever constructed, intended to be the crown jewels of Russia's Arctic expansion. For the U.S. Treasury and Western strategists, these ships are frozen assets, a $3 billion hostage in a geopolitical war of nerves. However, while the world focuses on these stationary hulls, a far more volatile signal is flashing on terminal screens in London, New York, and Hong Kong. As of early 2026, silver has shattered the $80 per ounce mark, a staggering surge that has caught the retail crowd and institutional shorts completely off guard. To the uninitiated, these two events, stranded ships in the Arctic and a silver squeeze in the futures market, seem worlds apart. But as a hedge fund manager looking at the macro grid, I can tell you, they are part of the same circuit. The Arctic is no longer just an energy province. It has become the vault of the North, the source of the world's most critical minerals, and the laboratory for a post-dollar financial order. Today, we are decoding how the blockade of $3 billion in shipping assets became the catalyst for a commodity-backed revolution that is pulling the rug out from under the Western financial system. The conflict on the Guidan Peninsula has evolved from a simple trade dispute into a full-scale maritime hot zone. The West's strategy was predicated on technological denial, by blocking the delivery of specialized tankers and prohibiting the export of liquefaction technology. The G7 believed they could turn Russia's Arctic LNG-2 project into a stranded asset. The siege of capital, Hanwha Ocean and Mitsui Oesk are caught in a legal limbo. They have built ships they cannot deliver, for a client they cannot charge, and for a route that only that client uses. This $3 billion in trapped capital is a gaping wound in the balance sheets of these maritime giants. For a time, it seemed the sanctions were working. Production at Arctic LNG-2 reportedly halted in late 2024 as storage reached capacity, the countermove. But Moscow did not play by the rules of the 20th century playbook. In late 2025, the Alexei Kosygin, the first domestically produced Arc-7 carrier from Russia's Zvezda shipyard, began its sea trials. This vessel isn't just a ship, it's a middle finger to the G7. It was built using a hybrid of reverse-engineered Western tech and Chinese propulsion systems, proving that the technological blockade has a shelf life, the kinetic turn. The tension reached a breaking point in January 2026. U.S. Naval and Coast Guard forces intercepted the Marinara in the North Atlantic and the Sophia in the Caribbean. These vessels, operating under the Shadow Fleet flag, were moving sanctioned energy and minerals. This marks a historic transition. The West has moved from financial sanctions to kinetic interdiction. When you start boarding ships in international waters, you are no longer managing a market, you are managing a war. Why silver is the strategic metal of the Arctic? To understand the price surge to $80, we must look at the industrial reality of the Arctic. Silver is the secret ingredient of the Northern Sea Route, NSR. In the extreme sub-zero temperatures of the Siberian coast, conventional electronics fail. Silver, with its unmatched thermal and electrical conductivity, is essential for the high-end sensors, GPS arrays, and specialized propulsion systems required for ice-breaking tankers. Furthermore, the Arctic is the world's next major source of silver and cobalt. Russia is consolidating its position as the fourth largest holder of these critical minerals. By pivoting the NSR into a trans-Arctic transport corridor, Moscow is now bypassing the Western-controlled Suez Canal to deliver these raw materials directly into the manufacturing heart of China. The silver squeeze isn't just a speculative bubble. It is a supply chain panic as the West realizes that the vault of the North is being locked from the inside. The logistics of the Shadow Fleet. The Shadow Fleet has matured. In 2025, over 100 sanctioned vessels traversed the NSR. This is no longer a collection of rust buckets, as described by the mainstream media. It is a sophisticated parallel logistics system, AI's obfuscation. These ships use advanced spoofing technology to project fake locations, allowing them to load gas and minerals while appearing to be in the Mediterranean. Non-dollar insurance. These vessels are insured by state-backed consortiums in Russia and China, rendering the Western price cap and insurance bans irrelevant. The icebreaker gap. Russia maintains over 50 icebreakers, while the U.S. operates only 2 aging heavy vessels. In the Arctic, sovereignty belongs to whoever can move through the ice. Currently, that is not the United States. The seizure of the Marinara was a demonstration of financial hegemony, but it may have been a Pyrrhic victory. Every time the US uses the dollar-based maritime order to seize physical assets, it triggers a bank run at the nation-state level. Flight to hard assets. Central banks across the global south are watching. Their response: a massive diversification away from US treasuries and into physical commodities. This is the fundamental driver behind the $80 silver and the gold rallies of 2026. If your dollar-denominated assets can be seized on a whim, you don't own them. You're just renting them until the landlord changes his mind. The BRICS unit. We are now seeing the pilot launch of the BRICS unit. This is not a common currency like the euro, but a digital trade settlement mechanism. Crucially, the unit is proposed to be backed 40% by a basket of gold and silver, and 60% by the currencies of the member states. The Arctic LNG and mineral trade is the real-world laboratory for this system. Contracts are being settled in yuan, dirhams, and rubles, completely bypassing the SWIFT messaging system. Peru, for the first time in 80 years, a major global trade route is being operated entirely outside the reach of the New York banking system. Perhaps the most cynical part of this 2026 landscape is the role of Europe. Publicly, Brussels condemns Russian aggression and supports the blockade. Privately, the data tells a different story. In 2025, the EU actually increased its intake of Russian LNG from the Yamal project to over 76% of total exports. The irony is thick. While the US Navy seizes Russian-flagged tankers, European ports in Belgium and France serve as the primary logistics hubs for Russian Arctic gas. The tankers that keep Yamal operational are managed by British and Greek firms. The West is effectively financing the very shadow fleet it is trying to dismantle. This internal contradiction in the sanctions regime is the smoking gun that proves energy security will always trump geopolitical virtue signaling when the winter sets in. The $3 billion in ships sitting idle in South Korea are a relic of a financial era that is melting away. The power shift we are witnessing isn't just about who owns the tankers, it's about the death of the unipolar financial system. The question for 2026 is no longer if Russia can survive sanctions. The question is, can the Western financial system survive the loss of its monopoly over the world's most vital energy and mineral routes? As silver pushes toward $100 and the Northern Sea route becomes a commercial reality, the message to investors is clear. The era of paper wealth is being challenged by the era of physical reality. The Arctic is the front line, but your portfolio is the battlefield. If you are still holding 100% of your assets in a system that relies on the rules-based order, you are essentially a passenger on a ship headed straight for the ice. The ships are moving. The vault is open. The rules have been rewritten in the frozen waters of the North.